Good morning and welcome to the Nedgroup Investments Global Fund Manager Workshop, where we will be reviewing the first quarter of 2021 and getting some insights from a range of fund managers from around the world into what they think the future's got to hold for us today. My name's Robin Johnson and I'll be taking you through the first three sessions today. Then I'll be handing on to my colleague Anil Jagmohan to round out proceedings and take you through the last three for the second hour. Now, we've seen a strong start to the year in 2021, with equity markets and global property markets giving you a return of 5% and 6% respectively. But we've also seen a tail off in the bond market with holders actually suffering a negative return of minus 4.5% to the end of March. Now, on the back of expectations that global growth will rebound as vaccines are rolled out and the pandemic subsides, and the potential for increased inflation with all the fiscal stimulus going on around the world. Now, hopefully, the range of speakers we have available to you today will be able to put some sense into what's going on in the markets and perhaps give you some guidance about what they'll be doing into the future. We have a range of experienced investors that are managers of our global range of Dublin-listed UCITS funds. And the running order today will be Julian Campbell-Wood from Resolution on our Nedgroup Investments Global Property Fund. Then we have Ian Beattie from NS Partners on our Global Emerging Markets Fund. We have a recording of a video with Brian Selmo from FPA on our Global Flexible Fund. Then I'll hand over and we'll go through our conversations with Tony Cousins from Perford on our Global Cautious Fund, followed by Andrew Headley from Veritas on our Global Equity Fund, and then rounding out the day with an interview with Jeremy Lang for our Global Behavioural Fund. First up today, we have Julian Campbell-Wood from Resolution, as I mentioned. Now, the property sector or global REIT sector worldwide solicits some polarized views, whether they are at an extremely attractive price point at the moment, given the pounding that they had last year during the pandemic, and the skepticism now whether the global real estate market has changed forever, or are they in a structural change that is too difficult to price at this point in time. Julian's a portfolio manager and one of the four experienced investors that we have working on our Global Property Fund from Resolution. And the fund invests in REITs from all over the world in a variety of segments that is an incredible array of industries and rental clients from that underlying REIT investments. They built an incredible track record over the last 15 years since inception of their global strategy, outperforming in every rolling 5-year period since that inception date. So with that in mind, I'm going to hand on to Julian now to take us through a short presentation before I get stuck into some questions with him. Good morning, Julian, and thanks for joining us.
Morning, Rob, and thanks for that intro, and hello to everyone. So the format of the presentation today, we'll cover three main areas: a quick update on the quarter, and then also look at portfolio performance and positioning. Then we'll talk about how REITs are positioned in the context of potentially increasing interest rates. Then we'll look at one of the new stocks added to the portfolio in Welltower, and we'll discuss the market outlook. Now with that, let's move into the market snapshot. So as Rob touched on in his outlook, really the quarter was characterised by the rollout of vaccines and the path to normalisation. Significant stimulus in certain markets, whether it was the 1.9 trillion in the US, 750 billion in Europe, has really given renewed confidence around the pace and magnitude of the recovery as we emerge from the pandemic. Yeah, that was one of the contributing factors to bond yields close to doubling in the quarter in the US and also Australia, but also some of those inflation pressures that we've seen, whether it's rising commodity prices due to some of the supply bottlenecks and pent-up consumer spending. When we bring it back to the REIT market, REITs delivered total returns of a little over 7%, just besting global equities. But again, if you look over the longer period, over the last 12 months, global REITs have actually meaningfully underperformed the broader equity market. And that does reflect some of the restrictions that are still in place in many developed markets. And we'll touch on that in a moment. Moving to the sector level performance, And what we saw in Q4 post the vaccine announcement really was some of those more impacted areas of the REIT market starting to make up some lost ground. So those areas where you'd seen real disruption in cash flow, hotels, select retail formats, and office property. And some of the more resilient areas of the market suffered that rotation. And the chart here, I think, provides some good context over the pandemic period. So the dark green line there is some of those real secular winners with strong visible demand and cash flows: data centers, cell towers, life science, residential, and self-storage. And you can see they've performed very well since the onset of the pandemic. The more challenged areas, retail, hotels, and office, have still underperformed, but have seen a sharp rally when that vaccine was announced, and that's continued in the most recent quarter. So that rotation has had an impact on fund performance, and it's fair to say in the last 3 to 12 months, the performance of the fund has been disappointing. We do need to put some context in there in that the fund performed very well entering the pandemic. So there was about 7% or 700 basis points of alpha in the month of March. But over the last 12 months, this really encapsulates that vaccine-driven rotation into some of those more challenged areas of the property market. And the philosophy of our strategy really since the outset has been generating total returns and wealth creation, but protecting to the downside. So you saw the fund perform very well going into the GFC, and as we did entering the pandemic. Some of that rotation we've seen into the more challenged areas of the market, that's a cyclical phenomenon. We believe that really need to continue to focus on those strong secular drivers. So let's look at how the portfolio has changed over the last 12 months and how it's positioned today. So the major change you can see here on the chart has been retail, a fairly significant repositioning of about 10% for the portfolio. And those of you who are more familiar with the strategy would recall that we've had a relatively cautious stance to retail property, but we did take the opportunity during COVID to add exposures that were facing some of the cyclical disruption rather than the structural challenge that e-commerce is putting on certain retail formats. So that's things like grocery-anchored open-air shopping centres in the US. It's things like Shaftesbury in the United Kingdom, who own a lot of the small shops around Covent Garden, Chinatown, etc. So portfolios seeing cyclical issues, but fundamentally are sound and will continue to serve their customers as we emerge from the pandemic. To fund those investments, we did reduce office exposure. We find it hard to build a case for how the COVID experience is a net positive for office demand. And we did also take some profits in some of the industrial and logistics exposures. Still 13% of the portfolio and very powerful demand drivers in that segment. If we look at how the portfolio is positioned today, the first thing you should take away from this is really the diversity of the opportunity set and the exposures in the fund. These are really leveraged to those major secular and demographic drivers, which will continue to underpin demand and total returns for these property types well beyond the cyclical disruption of the pandemic. So for some examples there, 22% of the portfolio in various forms of residential property, benefiting from urbanisation, even the suburbanisation during COVID. Logistics and industrial, 13% of the portfolio. Healthcare real estate, seniors housing, medical office, hospitals at 9% of the portfolio. Data centers and towers really benefiting from that digitization, the way we've all been living, working, transacting over the last 12 to 18 months is a very powerful secular trend which underpins demand for that real estate for many years to come. Another one there, life science and lab space. These biotech, pharma and therapeutic companies have seen extraordinary demand in the last 12 to 18 months, but really this is a secular trend which will continue and support the underlying real estate. So a hugely diverse range of high quality real estate, which is impossible to replicate in private markets and leverage to the major secular drivers, which will continue well beyond the COVID disruption. If we look at the experience of REITs during the pandemic, they've actually had pretty resilient earnings where we compare it to broader equities. So the chart on the left here, we've used US REITs and equities to illustrate the point. The dark green line is the US REIT earnings, far more resilient than what we saw from the broader equity market in the light green dots there. And despite that earnings resilience with all the COVID disruption, the relative multiples of the REITs, you've got to go back to close to the early 2000s to see a relative discount in terms of the multiples. So despite that earnings resilience, the REITs have underperformed and are at a relative multiple discount. Reiterating the point there is around the relative total returns. I touched on this at the outset, but this gives you some longer term perspective. Last year was one of the worst relative performances for global REITs, and that reflects the significant demand shock that real estate faced when many of the customers and tenants are locked up at home. But as you move into the recovery phase with pretty significant economic growth expected, we believe this sets up the sector pretty well to perform as we move into the early phase of an economic expansion. Now, the discussion on inflation and interest rates is an interesting one, and it comes up quite often. Here we're showing you the correlation between G-REIT total returns and 10-year government bond yields. And over a long period of time, you can see there is no consistent relationship. The argument that REITs are simply bond proxies does not hold. If you take that a step further and look at during periods of Fed interest rate hikes, so this is the green shaded bars versus REIT total returns, the green line being global REIT total returns, you can see that even during periods of interest rate hikes, REITs have generated positive total returns. What is critical is why rates are increasing, and if it's an expanding economy, economic growth, etc., and the fundamentals of real estate are in good shape, REITs and real estate can continue to generate competitive total returns. Because what matters is less about the discount rates or changes in the discount rates, but what are supply and demand and the capital management of these businesses doing. And I'll give you another example. If you looked in the UK over the last 3 to 4 years, you've had interest rates declining over that period. Yet UK malls have fallen in value by over 50%. It didn't matter that interest rates were declining. What mattered more was the underlying fundamentals were deteriorating. The supply and demand dynamic and rental rates are under significant pressure. So it's the real estate fundamentals which are critical to understanding the total returns of the real estate. So let's focus on those. Demand. 2 points really here. You've got the secular demand trends that we discussed, both whether it's digitization, e-commerce, the demographics, and these will persist well beyond COVID. Then you've got the cyclical demand, which will recover from what has been a very sharp contraction in demand due to all the restrictions that we've been living with over the last 12 to 18 months. Pleasingly, REITs have started from a relatively solid point of occupancy, as we're evidencing here with the US REIT chart. So for those areas of the market which have seen cyclical disruption, the strength of economic growth will support tenant demand to rebuild that occupancy. But many areas haven't actually seen any impact, whether it's logistics, data centers, towers, life science. These businesses have seen their demand pretty much hold through the COVID disruption. So the secular demand underpins it, and we believe the cyclical demand will recover given the strength of the economic expansion expected as we emerge from the pandemic. The next critical factor is building supply, so new construction or new buildings. And this really dictates landlords' pricing power. So the ability for a landlord to increase rents and drive cash flow. And that's critical at all points, but even more so if you have a view that inflation is likely to continue. Pricing power is what will enable REITs to generate total returns in an environment of increasing interest rates and inflation. And if we look at the COVID experience, unlike some prior recessions, COVID wasn't categorized by widespread overbuilding or too much supply when we entered the crisis. So the light blue line here on this chart shows you new commercial construction as a percentage of existing stock. And as you can see, that was below the long-term average entering the crisis. And the point here is simply that landlords still had pricing power and ability to increase rents and drive cash flow. And that sets up the sector well as we move into the early phase of the recovery. When we look at capital structures, again, this was an important point and an important reason we didn't see material levels of distress. Balance sheets were in reasonable shape at the outset of the crisis. Low 30% debt to GAVs, diverse sources of debt, and importantly, they maintained access to debt and equity during the crisis. So minimal examples of permanent capital impairment outside of select retail REITs really that entered with too much debt. So the fundamentals of the sector are in good shape. Demand, supply, and the capital management positions the REITs well as we move into the economic expansion phase. Now, to put the REITs in the context of what we're seeing in the private market, which is always a valuable context, it's a busy chart. I'd encourage you to look at it when you have time. It's simply showing the transactions in many markets, whether it's the US, UK, or Australia, in a variety of different sectors. The private market is transacting at prices sometimes meaningfully higher than where the public REITs are trading. So the REITs are trading at a discount to where we're seeing direct market transactions. Now let's move on to an example that's recently been added to the portfolio. So you may recall 9% of the portfolio is in healthcare real estate. Welltower is the largest position within that, which was added during the quarter. Welltower is the largest US healthcare REIT, and the majority of their portfolio is in seniors housing, also with skilled nursing and medical office buildings. Welltower is an interesting position in that it suffered a fairly meaningful cyclical impact during COVID. Sadly, that demographic bore the brunt of some of the worst impacts, and that has seen pretty material declines in occupancy and close to 25 to 30% declines in earnings. But that is a cyclical impact which will recover. This is a needs-based product, and as COVID has declined, you can see on the chart we're showing here, almost close to zero, you're starting to see occupancy rebuild, and that will provide a cyclical tailwind to earnings. The next piece of that is the demographic demand as you move into 2025-26 in the US, when that really starts to ramp up. So Welltower is an interesting story of both the cyclical and secular demand drivers in a company which owns a high-quality portfolio with a management team that's really taking advantage of a good cost of capital to grow the portfolio. Now let's touch on the outlook. As we move through and past the pandemic, the cyclical impacts will fade. And what will remain are those powerful secular drivers which are driving the economy and therefore the real estate that supports the underlying economy. The portfolio is positioned both in those secular trends, but also in some of those areas where you have seen cyclical impact during the pandemic, whether it's seniors housing, certain retail formats, certain residential formats in North America. So it's a blend, but those powerful secular drivers will drive real estate total returns for many years beyond the pandemic. The fundamentals of the real estate sector and the REIT sector are in good shape. And again, it's the supply and demand and capital management which will dictate real estate total returns. It's not about the shift in bond yields. And that's an important point to remember. When you look at the relative value of the sector, it's a discount to the broader equities market, despite the resilience evidenced during the pandemic, and it's also at a discount to direct real estate. So we think that's a pretty good setup for REITs as we emerge from COVID and move into that early phase of the economic expansion. So with that, I'll turn it over to Rob, and we can move into some Q&A.
Thanks very much, Julian. A lot of reasons to be positive there. We do have time for one question, I think, which I'd like to test you on, is you do have a decent exposure to logistics. Has the growth, will that continue, or is the pricing power starting to wane, given that we've seen a hell of a lot of development and construction in that sector over the recent past as the online retail phenomenon comes into play? Is there still attractive valuations there as well?
Yeah, it's a very good question, Rob. So in terms of are we seeing overbuilding and are landlords losing pricing power, we aren't seeing that yet in most markets. Yeah, so the big markets of North America, the UK, but there are markets where that is occurring. So you need to look through the aggregate levels, but it's smaller markets in Europe, like Poland, for example, or select markets in the US. But by and large, landlords still have pricing power. And if you look at Prologis, who reported results, and it's the largest position in the portfolio, they're still seeing accelerating rent growth and pricing power. And it's not just the e-commerce story, but the pandemic has actually driven their customers to increase inventory levels and some of that redundancy that they're keeping onshore, given the disruption you've had in supply chains. So the pricing power is still there, but you're right, it's not an undiscovered story. So yes, we do need to be mindful of valuation, and we did trim some exposure there, as we saw in terms of the rotation into some of the more cyclical impacted areas. But we still see some relative appeal in these vehicles, and we think the underlying trends are sufficient to justify the values where they're currently trading.
Okay, so sorry, just quickly then, last question. You mentioned that you've trimmed some of your exposure there, but you've also added in the quarter to a company called CTP. Would you just give us a very quick outline of what that company does?
Sure. CTP is an interesting little company. It's focused in Eastern Europe. Much of its portfolio is in Czech Republic and other markets like Hungary. And it's unique in the sense that it's 82% owned by its founder. It's a very active developer. It's developed around 70% of its portfolio. It has land owned or under option, which can almost double the exposure of the company, and it's really leveraged into those markets as they continue to develop their modern logistic and supply chain real estate. So a bit of a unique exposure, which expands our existing European and UK holdings of logistics in a well-run with a founder-led company. So quite unique in the logistics space.
Well, thank you very much, Julian. I'm afraid that's all we have time for. Thank you very much for joining us today and sharing the information about the real estate sector.
Thanks, Rob. Thank you, everyone. Enjoy the rest of your day.